we always start with the end in mind. When we purchase a property, what is that end going to look like? If we're going to sell it 5 years from now, 4 years from now, what is that property going to look like? What is the loan going to look like? Who is the buyer pool going to look like? What are they going to want out of the property? What are they going to want out of their loan? And we kind of reverse engineer it to now.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 248. Today, we're going to talk to someone who has achieved huge success investing in commercial multifamily and apartments. Recently, he's grown his company portfolio from 2,500 units owned and operated to over 6,200 units. He's raised money from both institutional and individual investors through syndications and closed-end asset funds. John Azar is an executive vice president and managing member of MACC Venture Partners, where he directs acquisitions, strategic development, capital management, and growth. In his past roles, John has been a commercial banker in various financial institutions and understands inside and out debt and equity financing, as well as deal structure and how to grow successful companies. John, welcome to the show.
Thank you so much for having me. I appreciate it.
There are so many different things we can talk about because, anyone who owns and operates over 6,200 units obviously has a wealth of experience and knowledge. But why don't we just start with you telling us a little bit about yourself and how you got started investing in real estate?
Sure. Yeah. I have been in the investment and finance industry for pretty much the entirety of my career. Other than right out of college, I worked for I sold some copiers when I was out of college. So you gotta wear all hats when you're younger. So
didn't Robert Kiyosaki sell copiers too? For Xerox?
I think so. Yeah. In fact, that's who I worked for. I worked for Xerox. That's in my 20s, and I knocked on doors and went door to door selling copiers. I tell you, I hated the job, but it taught me a lot of lessons. So it just kind of goes to show you gotta learn from everything you're doing, because whether you hate it or like it, you're learning from something constantly, and that's how I look at all of my experiences professionally and personally. So I became I was on the equity desk at Morgan Stanley earlier on in my career, and during the course of that time, I was also getting my MBA in Boston, and I left that end of the industry and started out a structured finance consulting firm, which was my first company I had with two other partners that were dealing with specifically mixed use residential real estate, or actually mixed use large scale development real estate. It had a lot of residential component to it, but a lot of the projects were really big in size, anything from a condo conversion project in New York that was over $100 million to bigger projects in the Seaport District in Boston. And, and I did that for about 4 years, from about 2004, 2005 to about 2008. And you can probably guess what happened in 2008 made me kind of pivot the business at that point. Or actually, we lost most of the business at that point, and we had to go back and go back to the drawing board and get day jobs because everything dried up overnight. At that same time, my brother Tony had already launched this previous iteration of this business that we have now, which is MACC Venture Partners. It used to be MACC Capital, MACC Properties at the time. I'm sorry. And was growing, we were just starting to buy earlier versions of some of our assets now in multifamily and apartments. And then in 2014 or so, I joined him in growing the business, and moved from Boston at the time to North Carolina to continue to kind of grow the business and take it to the next level and next iteration of it. And we've been in apartments since then. So we've in total, we've been in multifamily since 2008 for about 12 years, I guess, right now.
So when you joined your brother's business, was it solely and exclusively focused on multifamily and apartments? And what was the thought process then behind acquisitions?
We were doing mostly multifamily, but we were also doing some office, commercial office space as well. We still own about 4 commercial office spaces in Texas and Florida and Charlotte, but we have pretty much segued away from buying any commercial office spaces and focused exclusively on multifamily around 2014 area.
Where were you buying and where are you buying multifamily?
Yeah, we're Southeastern concentrated. So we are anywhere in North Carolina, South Carolina, Georgia, Tennessee. These are our 4 main states of concentration. We look in Florida, we look in Kentucky and Alabama and Southern Virginia, but most of the 4 states that we are mostly concentrating on are North Carolina, South Carolina, Georgia, and Tennessee for our own portfolio.
And what are your criteria in your portfolio? A, B, C type properties?
Yeah, we were very value add focused from the beginning. We have switched focus a little bit into including more A or A minus. Not quite, we're not quite buying luxury, but we have switched to going up the stream a little bit to closer to A or A minus. Before we were exclusively in B minus, C plus. So we've kind of moved our buying criteria slightly up. But we are mostly, for right now, we are mostly B minus to A minus A.
Explain to our listeners what you mean between the A and the B minus type properties.
Sure.
And why that criteria has changed more recently.
When we talk about A, B, C, when you hear those words or those numbers, those letters rather in multifamily or really in the commercial real estate industry, they indicate. So there are 2 different indicators. There's a location class, and then there's a property class. So there's a location. Location is also rated A, B, and C, and a property class is also rated A, B, and C. So you could have a B property or B asset in an A location. So let's say you have a apartment complex in, let's call it Manhattan, or Upper East Side. That's a place that everybody, no matter where they are around the country, could identify with. So if it's an Upper East Side, that would be considered A or A plus location. But the apartment complex itself may not be that well or that good. So it could be B, or B minus. As far as the asset itself. So that's an example of a B class asset in an A location. You can also have the reverse happen where you can have an asset that is A in a not so good location, in a B location or C location. Maybe you have a luxury apartment complex or ultra luxury apartment complex with stainless steel appliances and granite tops and hardwood flooring and all that kind of stuff. But you can have that in I don't know, in a secondary place like I don't want to call it secondary, but it's less than a major metro area, like maybe someplace like a Greensboro, North Carolina, or it's not considered necessarily a premier metro area, but it's still it's a great location in and of itself, but it's maybe not an A class location. So that's the difference sometimes when we talk about A, B, and C. And really, as far as the properties themselves, the differentiation between the different classes come in the form of what is included in the asset itself. So, you got A on the top level, you got A class luxury apartments. These are the apartments that have, anything from internally, they have luxury appliances and granite countertops and maybe hardwood floors sometimes. And a lot of great amenities. They have great clubhouses. They have this great swimming pool and maybe a workout gym, workout facility, maybe even a bocce court, or maybe a fantastic grilling area, or who knows, soccer field. I've seen it all. You start going downstream. So B class may not have a stainless steel appliances, may have black appliances, but still have granite countertops, or maybe they have not granite counter, maybe they have Formica countertops and black appliances, but still nice, just not as nice as the A luxury one. They would still have some amenities like pool and gyms and and a workout facility and some grilling area and stuff like that, but not as expansive as the A class. Then when you work your way down to C, you're gonna obviously the quality inside the units is gonna go downstream a little bit more. So you're definitely not you're gonna have probably a mixed match of appliances inside the units. You may or may not have Formica countertops. You never know what you're gonna have. You may or may not get amenities like pools or workout facilities. A lot of times you probably won't get workout facilities. You might get a pool. And then obviously the lower down you go, the less these amenities and quality is gonna be.
Take us through the process, because when you started working with your brother, you've since then you've grown the portfolio by just under 4,000 units. So that's quite a bit. What do you take us through a typical acquisition? What type of property you might buy, what you look for in the area, and how you're finding value in that property.
Our sweet spot is still B class property in a good B class area or B plus area. We would look into. We are value add for. We love buying in the value add space, which means we'd love to buy something that needs either a little bit of lift, either slightly small lift or maybe medium lift, meaning spending anywhere between $2,500 a unit to maybe $5,000 a unit, $6,000 a unit at the most internally on the unit itself, and then we'd spend a little bit more money on the amenities, whether it's the clubhouse or the driveways, parking lot, landscaping, whatever it might be. And our typical lift inside the units would encompass anything from changing the countertops and putting in new appliances, painting, maybe changing the floors from either carpet to wood or wood laminate, changing maybe some of the fixtures, upgrading the fixtures, upgrading the cabinets, or painting the cabinets. Depends on what that is. It really is depend on what we think that formula is going to yield for us in return. So depending on the rent increases. So it's all about the rent increases, what you're able to do, because you don't want to obviously shoot yourself in the foot going in someplace and you think, oh my God, I'm going to spend $5,000 a unit, but I'm only going to be able to get $2,000 in return, but from rent increases. So that just doesn't make sense. So if you're not able to increase rent accordingly with what you're spending to be able to recapture your spend dollars, and obviously and then some, then don't do it, or decrease the amount of spend you have on units. So it's really just a balance of what we think we can increase the rents by to what we think we can spend.
Well, give us a concrete example of that. Like, what is a recent property where you've gone in and done that type of value add process, and how much were you able to increase rents?
We always do it. We've done it. Our recent acquisitions is an asset in Augusta, Georgia, called Petersburg Place, but we're still in the middle of that. We've acquired an asset last year called Chatham Woods, which we're still working on, and it's in High Point, and we are again instituting that formula where we go in and spend about $2,500. Let's call it $2,500 a unit. We are able to increase rents on renewals. Usually, we don't usually increase. You're not able to increase rents on during the time when there is a lease in place. So what you're able to do is increase the rent upon renewals. So that's why it takes a while, typically, for a real estate operator, like us or anybody similar in our game, to really fully do the upgrade plan that they have or renovation plan that they have. It usually takes anywhere between 2 to 3 years in order to put in. Especially, it depends on the size of the apartment complex, obviously. But if you're buying 150, 200 units, it's going to take you a while to upgrade the units that you're slotted to upgrade during the time, because you're waiting on apartment turns, in order for you to go in and upgrade the units, and take about a week or 2 weeks. It depends what is the speed of your upgrade is going to be, and then turn around and put them back on the market and re-rent them again, and that's when you increase your rent. So, and again, I'm sorry if I'm being a little bit too explanatory about the process. I just want to make sure I don't know if want to make sure your audience understand how the process goes.
Yeah. So let's say you add $2,500 a unit to put in good laminate flooring or hardwood floor and upgrade the fixtures and finishings. What kind of rent increase might you be able to achieve through that?
So we're looking for typically we're looking anywhere between $120 to $150, $160, $200 a unit. It depends on the amount of upgrade that we've done in a unit. Depend on the market, what the market is willing to bear for the increase. What's comparable. What are renters expecting from comparable apartments nearby? That's the other thing that also makes a difference. I mean, you could upgrade the units. You can over upgrade sometimes, because if there are no other apartments nearby that are offering similar amenities or similar units around, you could do overkill, or maybe you're not upgrading enough. If your apartment complex is surrounded by other higher end apartment complex, it really is. You have to look and see how much you want to upgrade, and if you can get up to the value you're looking for. Mainly, it's about cash flow. So because we look at every deal that we look at from the moment we look at it when it's offered to us in the market to the time we close, it's really all about what kind of returns we can get for our investors, because all of our deals are syndicated, and all of our deals are we have investors, whether it's accredited investors, high net worth investors, or institutional investors. They're all still looking for returns that we need to achieve for them. And those returns are in the form of cash flow, annual cash flow distribution that we offer. And they participate on the upside of, IRR. So if we cannot achieve those returns with the rent increases we have, then, the deal doesn't make sense to us. So the numbers have to make sense to some extent. And I can't give you an exact number on what it is, but the average rent increase for us, typically when we do renovations, is again anywhere between $120 to $200 a unit.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Well, that's a great segue then into deal structuring, because you raise money both from individual, private, accredited investors and institutional money as well. How do you typically structure your deals? Is there one model and formula that you apply to every deal, or is each one different depending on the numbers?
It's not a cookie cutter formula, but there is an average that we typically do. I mean, there is a waterfall schedule. It's called a waterfall, which is essentially what is the splits between the investors and the owner operator, or the promote, essentially the split of the promote is what it's called in the industry. And that could go anywhere between, let's call it 30-70, 30 to us, 70 to the investors, to 60-40, 65-35, 75-25. It just depends on the deal itself. We typically build in achievement hurdles. So the more that we can give to the investors, the more performance that we can give them, the more we get compensated as well. So the more money they make, the more money we make. So we really always want to try to align ourselves with the investors, and as long as we can make them more successful and return more money to them, then we would get paid.
How exactly do you define those hurdles?
There are returns, essentially returns on, especially at the time of liquidity. That's when they matter the most, because during the whole time, the cash flow is really depending on the performance of the asset during the hold. So we offer what's called a pref rate, and a pref rate is typically anywhere between 8 to 9%. But we also go above and beyond that pref rate. That's where the cash on cash return comes in. So, which means anywhere. So the cash on cash really is just a product of what is overage from the rent that you've collected that you've made. So you've made, let's call it $10,000 in rent, or $10,000 in, yeah, let's call it $10,000 in rent, but it costs you only $8,000 to rent, to run the asset between debt servicing, operational cost, all that kind of. So you end up with $2,000 essentially. That is the cash on cash that you can distribute to investors. So that's what I meant. And that cash on cash is paid out quarterly, typically in our to all our investors. We pay them out every 3 months. Every 3 months, and assessed annually. So sometimes we pay out smaller amounts the first 2 or 3 quarters, and then the fourth quarter is a catch-up, what's called a catch-up quarter, because typically we like to make sure that we have enough operational cash to pay for any incidentals or anything that may happen in the property. And then the fourth quarter of every year is usually when we pay out any kind of overage. So their largest check in their distribution is going to happen in the fourth quarter. And then when we have a liquidity event, that's when sort of the true splits will happen, because the liquidity event, which means anywhere from a sale of the property to a refinance of the property to recapitalizing the investors, meaning either us buying them out or maybe bringing in fresh investment and cashing them out on the fourth year. Our average hold time is 3 to 5 years on all our assets. So some liquidity events usually happens between year 3 and year 5. Again, whether that's a sale event or a refinance event, whatever it might be, we want to make sure that they get their money and more. Obviously, they are pro forma. We typically pay out anywhere between, knock on wood, we've averaged the IRR for our investors have been in the upper teens, 20s, when is what they would make out of the investment with us, which is about approximately 2x their money. So if you put in $100,000 within 4 years, between your cash on cash return and your upside from liquidity event, you're going to make twice your money.
How exactly would you put in the hurdles where if you exceed certain numbers, you as on the GP side make more money?
Yeah, sure. The hurdles are done again as a percentage of return basis. So if I'm able to achieve overall on the average 12% for them, I get paid a certain amount. That's usually where it starts. Or 10 to 12% or whatever it might be. And then 12 to 15%, I would get a kicker. That's the first hurdle, for instance. So if I'm able to achieve 12 to 15%, my percentage goes from making 70-30 to 65-35. So it means 65 to the investors, 35 to us. If I'm able to achieve 15 to 18% or 15 to 19%, my percentage goes to 60, or their percentage goes to 60 and I get 40. So it becomes 60-40. And if I'm able to achieve anything over 20% for them, it goes to sometimes 55-45, 55 to the investors, 45 to us. It really depends. Sometimes it caps out at 60, meaning 60 to the investors, 40 to us. Sometimes it caps out at 65%, 65% of the investors, 35 to us. It really is that there's no hard set numbers. Each deal has kind of created its own numbers, but these are about approximate numbers of what you would expect as far as this, promote splits are concerned.
So it's kind of a stair step return. As the returns increase, you ascend and the stairs as far as how much equity you might be receiving and being paid on.
It being paid on the returns, on the overall returns of the project. Yeah. So that's what I'm saying. When we are aligned with the investor. So the more money they make out of the investment, the more money we are rewarded. We reward ourselves by performing the asset better. So I mean, if the asset is performing, like I said, at the highest, like I said, we return 20% or more to the investors, there's a reward parameter for us, but that means the investors are also making a lot more money. Yeah. So it's a double reward for both of us.
So John, you have a financial background, commercial. You were in commercial lending in different banks. How has that informed the way you put together these types of deals?
A lot. I'm able to get for the most part, I'm able to get a more holistic picture of where the thought process is, what is required of me, what kind of requirements maybe the bank look for to process a deal. Where are some of the number criteria comes in from a lender's perspective. And obviously an understanding of the holistic understanding of the deal cycle itself, what they think about, especially in terms of money movement, know your investors, to, to precautions they take to assure no bad actor laws are broken or anything like that. I mean, all of that is sort of taken into consideration. It gives me a better understanding of the full cycle of lending and executing a deal. So it's definitely brought a lot to the table for me, and I'm thankful for my experience.
What kind of terms do you usually get? Because one of the things that strikes me about what you just explained is that your investors can expect to be in a deal for 3 to 5 years. You know, a lot of times when you get a agency financing or CMBS or whatever, there's a prepayment penalty if you get out too soon. So how do you walk that line of making sure you can get out within 3 to 5 years without having some sort of high prepayment penalty?
The prepayment penalties are usually assessed on a descending ladder basis. It means they decrease the more time you hold the loan. Typically, we try to structure everything within 3 years for us not to have a minimum exposure to prepayment penalty. But a lot of times, if we cannot, we try to build that into our pro forma, into our underwriting, to be able to absorb it at the time of liquidity event or at the time of sale. So, hopefully by year 4, we have a very minimum exposure to prepayment penalty, and whatever prepayment penalty might be, we kind of build it in to be able to absorb it if there's a liquidity event. So, you may not be able to solve completely out of a prepayment penalty, but you build it in to where you can add another, million or whatever it is to your number and still be okay at the time of liquidity.
What's your go-to loan that you try to get on each acquisition? Is it different each time? Are you going maybe to a local bank at one point, Fannie Mae, Freddie Mac, or HUD? What do you go for? And then what type of terms do you look for?
Normally, we try to stick to mostly agency lending, so which means Fannie or Freddie type of loans. We don't really do CMBS. We don't do balance sheet loans much, which pretty much knocks out a lot of the smaller banks. So a lot of what we deal with is what's called DUS lenders. These are agency lenders. They typically specialize in doing lending for Fannie and Freddie type of loans. Yeah, I mean, our typical loan parameters are, again, it's an agency loan. It has 25 to 30 year amortization, 10 to 12 years permanent debt, maybe about 3 to 4 years IO, interest only period. And that's important because during that interest only period, that's when you do a lot of your renovation and your upgrades. And, that becomes pretty important in having that type of loan, because then at the end of that renovation period, that's when you really kind of cycle in the full number that you're looking to get out of the apartment as far as rent is concerned, or rent increases are concerned.
If you're going for 8 to 12 years fixed rate,
10 to 12, usually 10 to 12 years.
Just in my experience, because I've got some Fannie Mae and a Freddie Mac loan, the prepayment penalty is quite substantial at that point. So you're able to build in that prepayment penalty into your pro forma because you just assume you're going to have to pay it anyway. I mean, why is there a reason why you don't hold longer?
We don't hold longer because a lot of our investors expect for their investment to be turned with us at the time that we stipulated. So a lot of times, within 5 years or so, 6 years, investors are looking to switch into something else, either 1031 with us or 1031 into somebody else or another investment that they may have. It's just really a matter of expectation of money flow, of how they expect their money to be turned. Have we held assets longer than that 5 or 6 year period? Yeah, sure. We've had assets that we've held for 7, 8 years. But for the most part, we try to stick to that 3 to 5 years. And it's not a hard set necessarily. I mean, we've sold an asset a little under 3 years, and we've also sold an asset a little over 7 years. So it's really a matter of when you have a good timing. What is the upside? If there's an amazing opportunity in the marketplace, somebody comes to you and gives you a number you cannot, you can't beat, you can't turn down. Everybody's going to be happy, and why not? If somebody comes in and gives you, especially the market the way it's been for the past couple of years, if somebody comes in and gives us, I mean, we had an asset in Charlotte, North Carolina, that we weren't necessarily planning on selling, but somebody came in and gave us an amazing number, and we sold in a little bit less time, about a year or two less time than we thought we were going to hold it. But that's just how it goes in the industry. It just depends on what the opportunity may present itself. And to answer your question, yeah, we do build in some absorption of the prepayment penalty, but the reason we take out longer terms is because we want to make that loan also sometimes assumable. So a lot of times, if the loan is assumable, they can avoid some of the prepayment penalty if they assume the loan. And if the loan is assumable, we want to make it as attractive as possible to the next buyer. So if we sell it within 4 or 5 years and the loan still has a good 5 or 6 years on it, at an amazing rate, say we got the loan, again, rates have been pretty low historically in the past few years. If we're able to pass a loan on with such a low rate to the next buyer, then that's a win for them. So we always start with the end in mind when we purchase a property. What is that end going to look like? If we're going to sell it 5 years from now, 4 years from now, what is that property going to look like? What is the loan going to look like? Who is the buyer pool going to look like? What are they going to want out of the property? What are they going to want out of their loan? And we kind of reverse engineer it to now and kind of work our way backwards that way, if that makes any sense. And that's really how we assess a lot of our deals. As we start with the end in mind and we kind of work our way back.
Yeah, it's interesting you say that a lot of your investors want to be in the deal for no longer than 5 years. And because I've struggled with that question myself. There's one fund that I have going on right now that's a 5-year fund. And people say, well, why is it only 5 years? And my answer to that is, well, it's kind of a marketing reason because a lot of investors don't want to tie up their money for longer than 5 years. But yet I have another syndication where my investors are happy to stay in it as long as possible. And we've been in it over 5 years at this point. So have you found that most accredited investors like to be in and out within 5 years, or do you have some that would prefer longer?
Most of ours do. Yeah. Most of ours would like to get their money out or know that their money's being moved around within 4 or 5 years or so. I think it's more of a psychological purpose more than anything that they feel like their money staying more fresh, in 4 or 5 years. It's getting into maybe better exposure or better projects, or if there's a better opportunity somewhere. It's also a lot of our investors, at least, tend to be slightly older. A lot of our accredited investors, so they just want to make sure they have more flexibility with their money to move around. They don't want to tie up their money for 10 years, because a lot of them are maybe in their 60s or late 60s, and they want to make sure they kind of move their money around and have some liquidity events that are timed to their liking. So that's another reason. Have we had investors stay with us for, like I said, 7 years? Yeah, we have.
And you mentioned that you don't typically work with CMBS, commercial mortgage-backed security lenders, or balance sheet lenders. Is there a reason why you prefer the Fannie Mae and Freddie Mac over the CMBS or balance sheet?
Sure. I mean, agency lending typically has a bonus to it, so it usually gives you an incentive, either a percentage rate, an interest rate kicker of some sort. Either it goes anywhere between 15 to 20 basis points sometimes on the interest rate. You get favorable terms. There are a lot of good reasons why you use an agency lending criteria rather than a CMBS. Now, there's also some good reasons sometimes to look for CMBS or maybe small balance sheet lending. I mean, if you're looking at for instance, a new construction project, or a project that might have a bridge lending requirement to it. Maybe it's a we've come across something like that in the past where we've taken on an asset that's not quite finished in occupancy. It's a brand new construction. They've occupied 70% of it and they have 30% of it still to fill up. So in that case, you cannot qualify. You're not going to be able to get a permanent financing for Fannie and Freddie. What you're going to be able to get is some kind of a bridge loan or bridge financing to get you over that, that 90, 92, 95% occupancy phase. So in that case, you take on some bridge financing or some shorter term financing that's going to get you to maybe 1 or 2 year mark, or 2.5 year mark, whatever that might be, 18 months mark, to where you get your occupancy where you want it to be. And then at that point, you can refinance into a more permanent loan situation. So we've done that before as well.
And then also I wanted to ask you about the difference between working with accredited investors and institutional investors, and you work with both. How are each similar and how are each different?
And accredited investors, obviously individuals. They are, I don't want to say friends and family, but they are individuals, high net worth individuals who meet the accredited investor criteria, which means that you have to have $1 million plus of net worth, make over $250,000 in income annually, or $350,000 if you're a household. So it's really just it's a federal guidelines requirement for what an accredited investor might be. A lot of times we would use, so if you go to our investment portal, there's an accreditation that is done through our investment portal that a lot of our investors have to go through to accredit that they're certify that they're accredited investor. A lot of what our offering, the reason we have to do accredited investors, because most of our offerings are what's known as 506C offerings. And 506C offerings are offerings that are by SEC guidelines and federal guidelines are offerings that we can advertise, but only to accredited investors can they participate in the deal. So you can advertise a deal in a 506C, but you'll have to make sure that anybody who comes in on a deal or gets financial information on a deal is an accredited investor. There's also a 506B offering, B as in boy, which you cannot advertise at all. These investors that you bring into a 506B offering have to be investors that you have a previous relationship with, or you have known. We've done those in the past, but most of what we do now is 506C. C as in Charlie.
John, I want to switch gears here just a little bit. I want to talk about your background, because I know that your family comes from a different country. And I heard you on a different podcast talking about that, and I found it really fascinating. Can you just tell us a little bit about your family, your background, and your experience?
Sure. My family is originally from Syria. We are Syrian immigrants. I moved to the United States when I was 16 years old. We immigrated in the late 80s to the U.S. And we kind of my father made a decision to leave it all behind for a better life for his family. It's just like a lot of immigrant families come to the U.S. He happened to be, you're right, because obviously 6 or 7 years ago, there was the Syrian civil war. The newest Syrian civil war started, and the country had been in civil war for the past 5 or 6 years. So luckily, we got out at the time we got out. And we've built, we came here, my whole family, and my 2 sisters here. I have a brother here. I work with my brother, obviously, is the CEO of the company, and my partner here. So it's, we've been lucky, and I guess it's a combination of luck, hard work, and perseverance to kind of get you where you are.
And I'm really curious, your experience as an immigrant to the United States and just the success that you've achieved. What in your background as an immigrant do you attribute to that success? Or is there something else you can attribute that success to?
I think being an immigrant gives you certainly a different perspective on maybe what you should be thankful for, and what kind of things you should expect for yourself and achieve for yourself. I was having a conversation about that recently with someone, and I think the fact that our father sacrificed almost everything to immigrate the family to the United States. He left everything behind. He left his home. He left money. He left success. He left everything. I mean, and the family, had to start from the ground up in the United States. I think that in itself motivates you to think that, hey, I don't want to screw up my life because my dad and our father built this trajectory and sacrificed so much to get us here. I want to make sure that I work hard enough and produce some results that are significant enough to for me at least to make it worthwhile, to make his legacy worthwhile. My father's no longer living, but to make his legacy worthwhile, that he moved to the United States. And the fact that you're actually also an immigrant gives you a different perspective on what you should be thankful for and what you should have. I don't really, if and somewhat more resilient. That makes me a little bit more daring, a little more resilient. If I was to be able to, I hate to say it, if I was to lose everything and start from scratch, it's fine. It's not a big deal. Like we'll just have to reignite that engine again and start again. So I think it gives it gives a lot of immigrant have that mentality where it's okay. They don't mind being knocked down and they can just get back up and kind of try it again, because that's what they've always done when they immigrated to a new country. They had to restart. I mean, that the process of immigrating to a new country is starting over. So the fact that the whole concept of starting over and resiliency is kind of built into the immigration mentality.
And John, I know that you're also switching gears somewhat yourself in going forward and how you're going to be doing some business. Can you talk about what you have in store for the future?
Yeah, we are slightly switching gears. We are still going to be obviously syndicating our own portfolio and finding assets, even though assets have been tough to find. But we're also launching a new, what's called the sponsor fund in the fall of 2020 coming up. And a sponsor fund essentially is we're going to be switching the tables. We're going to be offering co-GP and LP participation with sponsors across the United States. So, which means we're going to become the money source for sponsors like us or syndicators like us across the country. The fund is going to be, we're shooting for a $300 million fund, and it will be participating with, again, funding sponsors in multifamily specifically across the United States. So it's not going to be focused just on the Southeast. It will be U.S. wide. So that is one thing I'm very, very excited about and very excited to launch and work with a lot of sponsors across the United States on.
Yeah, how will you be vetting those sponsors?
Obviously, us have been a sponsor and still are sponsors that we've been for the past 12 years. We will be using a lot of our criteria of what we look for typically in our due diligence. A lot of the numbers obviously have to make sense for our fund in order for us to participate with sponsors. We're still going to have return parameters, return requirements on what we think the returns should be. Cash on cash. I don't want to give a lot of numbers out right now, but there's definitely going to be some return requirements in order for the fund to invest in a certain property. And the good part about it for sponsors is that we'll be able to obviously provide any insights that they may have just from a sponsor perspective, because we're not just a bank, we're not just a money guy. We have walked in their shoes and still walking in their shoes to a large extent. So we will bring a lot of that experience to bear for them, and hopefully give them some good insights along the way, and not just money.
Yeah, and how would people get a hold of you or find out more information about you?
It's a good question. They can go to our website, maccvp.com, MACCVP, VictorPaul.com, as in MACVenturePartners.com. They can email me directly at John, JOHN, at MACCVP.com. They can find me on LinkedIn. I'm under Jalal John Azar over there. They can find me on Instagram. I'll even give out my phone number. I don't mind sharing that as well. It's 617-519-6211. They can get hold of me that way. Another thing to mention is that we're also launching a coaching program in multifamily specifically, and we really don't advertise that program much, but it's a very custom program for anybody who's interested in upgrading their business from whether they already own 1,000 units and they want to get to 5,000, or they already own 4,000, they want to get to 10,000 units. So it's really helping sponsors achieve significant growth in their multifamily business.
Any final thoughts or words of wisdom for our listeners?
Look for your ways of growth and your path of growth, and because your path of growth may not be somebody else's path of growth. I mean, so it's what I mean by that. Don't compare yourself to anybody else. Don't compare your success to anybody else's success. You find and drive for your own success, and however ways you can get to it. But make sure you are driving. Make sure you are leading your success on your own. Nobody else is going to give you anything. Nobody's going to hand you anything. Nobody hands us anything in this life unless we go after it and take it ourselves. So, don't wait on that opportunity to come knocking on your door. Go start knocking on doors yourself.
Fantastic. Well, John, I want to thank you for having this conversation with us today. It really just learning about how you structure deals, financing you work with, as well as the types of investors you work with has been really interesting. I find your experience as a Syrian immigrant fascinating, and just how that shapes your perspectives. Thank you so much for being here today.
Absolutely. Thanks so much for having me. It's been a pleasure.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at RPOA